Imagine stepping into a bustling Texas Roadhouse. You know, that familiar smell of sizzling steaks, peanuts on the floor. It's a really iconic American restaurant experience. But today, we're actually going behind the scenes. Past the lively atmosphere, we're going to look at the financial numbers, ones that really tell the story of this casual dining giant. We're taking a deep dive into Texas Roadhouse Inc.'s latest financial results, specifically the second quarter of 2025 and the first half of the year, too.
Right. And our mission here is basically to unpack the key insights from their newest earnings report and also their latest 10Q filing. That's their big quarterly financial report. Gives us a much deeper look than just the headlines. We'll get into what's really fueling their growth, what challenges they're, well, navigating pretty expertly, it seems, and what their future strategy looks like.
Yeah, so you, the listener, should walk away with a pretty clear understanding of the forces shaping one of America's most recognizable restaurant chains. And just so you know, our analysis is grounded entirely in Texas Roadhouse's own official stuff. Their press release on the Q2 results and, like you said, that comprehensive Form 10Q filed with the SEC. Ready to dig in.
Let's do it.
Okay, so let's kick things off with the big picture, the top line story. I mean, Texas Roadhouse is showing some really impressive financial health overall, aren't they? Looking at Q2 2025, they pulled in, what, $1.512 billion in total revenue? That's a solid 12.7% jump from last year.
Yeah, it really is. And for the first half of the year, they're almost at $3 billion, $2.96 billion to be exact, which is up 11.2%. Pretty strong numbers.
But are figures like that sustainable? I mean, in a market that's always shifting, how does that translate down to the bottom line?
That's a really good question. And, well, it does translate pretty effectively. Their net income went up 3.3% to $124.1 million in Q2. And maybe more importantly for you, the listener, thinking about investment, diluted earnings per share EPS got a 4.0% bump to an $1.86. So what these numbers really show is Texas Roadhouse's kind of remarkable ability to keep growing and generating real value for shareholders, even when things are, challenging economically out there. It suggests a certain stability.
Okay, so growing the business is clear. But what about directly returning value to shareholders? Are they focusing on that too, or is it all just going back into, like, new restaurants?
Oh, they definitely are. It's a core part of what they call their disciplined capital allocation strategy. So the company just approved a quarterly cash dividend, 68 cents per share. That's actually up from 61 cents last year, payable into September. Plus, they're doing share repurchases. They bought back $9.8 million worth in Q2 and $60 million so far this year.
So it's a mix then.
Exactly. It highlights that kind of multifaceted approach. They're balancing, reinvesting in the business, new stores, acquisitions, but also sending capital straight back to shareholders with those dividends, which are growing, and the buybacks.
All right, let's shift gears a bit. What's actually driving those impressive sales numbers? What's the secret sauce, if you will, behind their operational success? Comparable restaurant sales. They were up 5.8% at company spots in Q2 and 4.7% for the year so far.
Right. And what's really compelling, I think, is why. The sources are clear. It's driven by both positive guest traffic and an increase in the per-person average check. That positive guest traffic part is key. It means more people are actually choosing Texas Roadhouse walking in the door.
Not just the regular spending more.
Exactly. It really speaks volumes about customer satisfaction, loyalty, especially in such a competitive sector. People aren't just putting up with slightly higher prices. They're still coming, maybe even more often.
Okay, and speaking of that higher per-person average check, how much of that is just them hiking prices?
Well, that's definitely part of it. They did roll out a menu price increase, about 1.4% in Q2, and that was on top of increases they did back in 2024. So yeah, pricing helps that average check. But here's something else that's really interesting.
What's that?
The growing importance of to-go sales. They climbed to 13.3% of their restaurant sales in Q2. That's up from 12.6% last year.
Huh, almost $1 out of every $7.
Pretty much. It shows this persistent shift in how people are dining, and that Texas Roadhouse is adapting well to that off-premise demand.
And it's not just sales at existing places. They're clearly pushing for growth, right? Opening new locations.
Oh, yeah, definitely in growth mode. In Q2 alone, they opened 4 new company restaurants and 1 franchise one. Year to date, that's 12 company-owned and 1 franchise.
Seems like steady expansion.
And they hit a big milestone, too. The CEO, Jerry Morgan, he highlighted the opening of their 800th restaurant system-wide. He said it shows their ongoing commitment to growth. Plus, they've been buying back some franchise locations. They acquired 17 domestic franchise restaurants so far this year, spent about $94 million on that.
Why buy back franchises?
It directly helps what they call store week growth. Basically, it adds more operational weeks under the company's direct control and revenue stream. They explicitly state it aligns with their strategy to boost net income and EPS. They even booked a small gain, $1.2 million, on some previous investments related to those buybacks. Pretty savvy move.
Okay, so sales are strong, expansion's happening, but it's not all smooth sailing, is it? The restaurant industry always has headwinds. Let's talk about inflation and margins. We saw that restaurant margin dollars actually went up 6.1% in Q2. But the margin as a percentage of sales actually went down by 108 basis
Right
points.
down to 17.1% in Q2, and year-to-date, it's down 92 basis points to 16.9%.
So how does that work? More profit dollars, but a smaller percentage profit on each dollar of sales.
Exactly. It often raises that question. Basis points, first off, that's just hundredths of a percent. So 180 is 1.08 percentage points. It's really about scale versus profitability per dollar. They're making more total profit dollars because their sales volume is so much higher now. But the cost to generate each dollar of those sales has gone up.
Yeah.
So the rate of profit, that percentage margin, gets squeezed a bit, shows they're expanding but feeling that cost pressure.
And what specific costs are causing that squeeze? The reports seem to point to two main things, right? Commodities and labor.
Yep, those are the big ones. Commodity inflation was 5.2% higher in Q2, 3.7% year-to-date, and they specifically mention higher beef costs.
Which makes sense for a steakhouse. Big input cost.
Absolutely. And then there's wage and labor inflation that was up 3.8% in Q2 and 4.2% year-to-date. This is driven by, the tight labor market, state
Wow.
minimum wage increases, tipped wage increases, plus investments they say they're making in their own people.
These sound like industry-wide problems, though.
They absolutely are. These challenges aren't unique to Texas Roadhouse. But the story here is how they seem to be balancing these pressures, largely through that strong sales growth and their pricing power.
And it looks like they're managing some costs elsewhere, too. The reports mention other operating expenses actually decreased as a percentage of sales.
That's right. It helped offset some of that inflation pressure. It was mainly due to lower costs for general liability insurance and also lower incentive compensation compared to the previous period. So a bit of a cushion there.
Okay, so let's look ahead then. What's their strategic outlook?
Investment plans, growth targets. How are they planning for the future? They talk about that disciplined capital allocation strategy. Is that just corporate speak, or is there real substance there? Oh, it's definitely substance. Look at the numbers. Capital expenditures, so money spent on building and fixing restaurants, was $92.5 million just in Q2, almost $170 million year-to-date. Then you add those franchise acquisitions we talked about, $15.5 million in Q2, nearly $94 million year-to-date. Like we said earlier, the direct returns to shareholders. Dividends were $45 million in Q2. Over $90 million year-to-date. Plus the share buybacks, nearly $10 million in Q2, $60 million year-to-date.
That's a lot of deployment of capital.
It is. And to make sure they have the flexibility, they got a new $450 million revolving credit facility, basically a big line of credit. As of July 1st, they had almost $447 million available on it and hadn't borrowed anything against it yet, so plenty of financial firepower. They also approved a new $500 million stock repurchase program back in February. Signals a long-term view on returning value.
So putting it all together,
Yeah.
what's management's vibe for the rest of 2025? Are they confident despite, everything going on?
The outlook they provided seems, well, quite confident, yes. Despite those headwinds, they're expecting commodity cost inflation around 5% for the full year, and that includes estimated impacts from tariffs. They see wage inflation around 4%. But crucially, even with those cost bumps, they're sticking to expectations of continued positive comparable restaurant sales growth.
So they think they can keep bringing people in and manage the pricing.
Seems that way. They also project total store week growth of about 5% for the year, and that includes a 2% boost just from buying those franchise stores. Capital expenditures for the whole year, they're projecting around $400 million. So yeah, it paints a picture of a management team that feels pretty good about driving long-term value through smart growth and solid operations, even with inflation sticking around.
And there you have it. We've kind of peeled back the layers on Texas Roadhouse's recent quarter. From that strong revenue and earnings growth really seems driven by loyal customers and smart pricing to those persistent inflation challenges with food and labor. And we also got a clear look at how they're using their money. New stores, buying franchises, paying dividends, buying back stock. It's a full strategy.
It really is. And, as Texas Roadhouse keeps growing and adapting, like embracing that whole to-go trend, it makes you wonder, right, What's next for casual dining overall? Are we going to see more tech in the service model, maybe more focus on like shoring up supply chains, especially with commodity prices being so volatile? What kind of dining experiences are companies like this planning for as they juggle these economic pressures, but also try to meet, changing customer habits?
Definitely something to think about. What does the future of just grabbing dinner out look like? Interesting stuff.